Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is June 12th, 2025, and we're going to follow up on our discussion about inflation, specifically CPI and PPI showing a slowdown or a disinflation move. Now, disinflation move is going to be anything that is still positive but compressing, so slower than the previous month, slower than the previous year. You can see our CPI number went from 0.2% to 0.1%. That means that very little inflation month over month. Year over year, it, however, rose. So when we're looking at the difference, we still have an increasing inflation year over year. So we went from 2.3 to 2.4. Yes, it missed expectations, but we're still climbing. We're still seeing inflation year over year climb. Now, that is with, as we discussed yesterday, that is with or in conjunction with energy being down significantly. So CPI, when we take core CPI, it went from 0.2 to 0.1, and that theoretically is taking energy cost or oil cost out. The problem with that is oil has impact on cost for transportation, food, and other things that is not removed when you go to core CPI. If we look at PPI, PPI went from negative 0.2 to 0.1. So this is deflationary, and this is disinflationary from the previous number, but not from the estimates as we're looking through there. So as we're looking at that 0.1%, that's in line with CPI month over month. But digging into the data a little bit deeper, if you look at PPI, Producer Price Index, which generally tends to be a precursor to CPI in the following months, overall dropped to 2.7%. But when we look at food and energy, energy says it did not move, it did not change. So less food and energy, it still has inflation up 0.2. Reality is, inflation and oil prices are on the rise. So even though we're looking at May's numbers, when we say May into June and June continuing to push energy prices higher, this is going to tell us that next month PPI is going to be positive. Next month CPI is going to be positive. We are likely to see an expansion of that inflation pressure. So when the market sees PPI and CPI coming in disinflation, and therefore they're calling for rate cuts and kind of victory laps that we're going to see lower costs and lower expenses, it doesn't bode well, or the data doesn't seem to support that when we see that oil prices have rallied off their lows and are breaking through key levels. Let's take a look at crude and see where we've gone to and where we've come from in the last couple of weeks. As you can see, crude prices fell all the way down to $54 back in April. We retested that the very last days of April and early May, and we reversed off of those lows around 54 all the way up to 68. My comment for the last couple of months is until we get through 68, I don't know if we can get real bullish on oil. As you can see, we closed above 68 yesterday. We retested the highs near 69 and pulled back to retest the monkey bar. This is likely the confirmation that your trend has reversed. We could look at this as an inverse head and shoulders, and that inverse head and shoulders goes from 54 to about 64. So we should be looking for 74 as a potential target in crude. If crude prices continue to rise, then inflation is going to rise as well. From the low to the high, if we look at percentages from month to month, and we're just going to go for May, we won't even go off the lowest price. We're going to say from May opening price, right here, to today, the high we put in today, oil has increased by 20%. So for 6 weeks worth of data, oil has increased by 20%. So even though May showed, hey, we didn't really have an increase in costs, well, we really did. We had about a 5% increase in oil prices, and today's high shows 21%. That means Producer Price Index and CPI are going to be higher in the upcoming reports. Unless something magical happens with some other area, energy has a significant impact. Some people estimate 10 to 15% on the bottom line, but when you adjust for the cost of transportation, plastics, etc., and all the petroleum industry's products, we're really talking about a much more significant move in inflation. So I don't see this as inflation being done. If that's the case, should we be betting on lower rates? Should we be expecting stocks like the Russell Index, which are all the small caps, should we expect them to be going higher on rate cut hopes? Well, let's take a look at a couple. If we just use the CME's Fed Watch tool, we can see that really we don't expect anything here in the next couple of weeks. But if we look out to July, the probability of a rate cut from yesterday to today increased by about 4%. Most are saying that it's later in the year. So let's go out to September, and we can see that the probability of a rate cut from the current to the next increased only 2%. The market isn't expecting it. There's talk about it, but the market really isn't pricing it in, at least in the move today. 2% is not a lot of expectations. In fact, we see that the whole probability is about 60% of a rate cut by September, but from yesterday with inflation data, or last week with inflation data, it really hasn't changed much. We were already betting on it. The PPI and CPI is not supporting the idea any more than what was already priced in. So if that's the case, we already had it priced in. And if we already had it priced in, we should not be betting on the small caps like the Russell. We shouldn't probably be betting on the technology stocks as it's reaching a key level, the yearly level, the monthly level on the NASDAQ indexes. So as we're looking at the breakout in crude, if inflation is going to be higher, then we're probably not going to be pricing in as much probability of a rate cut by the time we get to September. We could be pushing it higher and higher, which means that inflation is going to go up and up, and the Fed is going to be painted into a corner again on whether they can cut rates or not. If we take a look at the Russell today, this is a gap down close up, which would be an exhaustion gap, and you'd usually expect it to fill the gap. It didn't fill the gap. It just kind of touched the lower shadow, but that's a clean representation of, no, this was overpriced, this is fair price. This is not pricing in rate cuts. The Russell should have had a better lift out of that. If we look at the QQQ, the NASDAQ ETF, you can see we haven't moved off of this 50% level. And if we looked at the futures, you'd see that it's at the yearly and the monthly top of the line market level for what I would say may be the market top for the rest of this month, for the rest of summer, and further. But if we're not going to get the rate cuts, don't bet on this. So if this is the case, if what I'm saying is true, you should have seen defensive stocks do better than technology and others. So if we look at the defensive stocks and such things as XLU and healthcare, XLV, and consumer staples, we'd be looking for this type of behavior. So the market can't move higher in the areas that normally lift it, like the technology, and is moving higher in utilities, healthcare, and consumer staples. This would be a very good buy signal as far as utilities, and I'll be looking at doing that in our deep currents portfolio. We will also be looking at a continuation in the healthcare. As you can see, we're pushing up to the highs of the day. And consumer staples is sold off a little bit more, but this is where I'd be looking for a confirmed breakout above 81, and I'm expecting this to go up to 84. So utilities, healthcare, and staples are still showing the defensive sectors are the strongest in this inflation, non-inflation, disinflation environment. And this seems to be holding up, saying we are not convinced that we are out of the woods and we're going to be cutting rates and growing. Bet on safety. And that's what I'm going to be doing. So I'll continue to look at some safe plays there. And I may be going into something like Duke on a break above 117 because it does give us a lot more upside potential. Stocks like Southern have already made their move, and I would like to see a small pullback and a continuation above the highs. But there's a number of stocks inside of utilities that we can certainly lean into as well. For those of you that were following when I said I liked industrials weeks and weeks ago, this looks like we've rolled over at fair price. So even though industrials had a decent bounce off of the gap down today, I am not expecting industrials to break through this high if we don't truly see growth. So until copper takes off, I'm saying this is the area that we want to start looking to take profit on those industrial positions, anywhere from 145 to say 144 in the XLI position. But that's just more of a take profit. I'm not ready to go short. I'm just saying we've probably run the course of the bullish move in industrials. Well, that's going to do it for me today. Join me again tomorrow, and we will look at some long-term trades and possibly setting up some of these positions in utilities, healthcare, and staples. Have a great night.